So what we're noticing within the shared services and outsourcing market is that clients are looking differently at what they are expecting from their outsourcing relationship. And they're focusing away from just benefiting from the labour arbitrage, which was a very, very key focus up until recent years, recent months. So I'm curious to know, in what way is Genpact delivering benefits away from just the headcount and salary savings? And as well, where is the evidence of this?
So let me start with the evidence, because I think the question that you've made is a very core one in terms of our industry. So let me first give you some evidence. Last year, Genpact delivered 2 times almost its revenue, or 1.7 times its revenue, in terms of business impact, which means cost savings, working capital improvements, loss reduction, revenue growth, many different aspects of it, beyond the contractual arrangements of the engagement that it had with the customers. And when I say business impact, these are not hypothetical internal numbers. These are actual financial numbers signed off by the customer's CFOs. Now, if you think of that as a statistic, you can clearly realize that the focus is definitely shifting away from the core arbitrage and the core efficiency productivity glide paths that has been the standard of this industry for many years. And by the way, 2012 was not a unique or an aberration year for us. We have been trending in this 1.5 to 2 times revenue business impact range for a few years now. Most of that impact does not just happen in the area that we only execute. Many of that impacts happen upstream and downstream in a client's end-to-end, what we call the enterprise process, such as order to cash or procure to pay or record to report, or in a banking institution, a whole mortgage refinancing model or a claims management model in insurance, and therefore actually addresses the effectiveness point that we talked a little while earlier about. So to summarize my response to the question that you just asked on how the market is moving away from arbitrage and cost to what are the other value drivers they're looking at. In Genpact, for example, in the past few years, we have on an average created between 1.5 to 2x of our revenues every year in terms of additional business impact to our customers over and above the contracted cost savings and the arbitrage and the productivity that has been signed up in our engagements. Now, clearly this is an aggregate number, is not an average for every individual customer. And the reason for that is to develop that kind of benefit, one needs to work in partnership with the customers across the entire value chain of what we call enterprise processes, such as order to cash or record to report or the whole claims management process in an insurance company, and drive both upstream and downstream fundamental changes. We do that with a bunch of our customers. Depending on the life cycle and maturity of some of our engagements, there are customers who are at that time possibly in transitions or in the early stage of stabilization, where obviously the opportunities for similar co-working towards benefits are more limited. And therefore, this is not an average across every single customer, but more an aggregate number as a company.
And obviously that's a very compelling figure that you've just shared with us, that the business impact on your clients is 1.5 to 2 times the annual revenue of Genpact. So this is really quite considerable. And you're saying that this is in addition to what you've pledged in your contract negotiations as far as what contractual savings could be. What is it that some clients are doing that makes that client see a more aggressive return on their investment?
Great question, Susie. I think the fundamental difference between clients who get those kind of benefits versus some clients who don't, apart from the life cycle and the maturity of the relationship, because as I said, in some cases the focus has to be on initial stabilization, initial service delivery before you go down these kind of transformational work. The fundamental difference is really the approach of the client to work with us as core business partners for driving some of their enterprise goals and objectives. So let me give you an example. A global pharma client of ours took an objective of reducing their overall finance and accounting cost by 25 or 30% within a span of 2 years. Now, that's not just the cost that they pay us, but it's their overall finance cost. Clearly, to drive that, you need to do a bunch of core changes in your processes, procedures, technology models in terms of how you drive some automation and how you simplify and standardize. And we are working along with them. And it's obviously a multi-year journey, but we are working along with them. We have delivered already ahead of that for the chosen areas in the first couple of years, and we are on track working with them to deliver that over the next couple of years. We are partnering with them in a bunch of areas. There are other areas which they are doing themselves, but overall, the project is on track to deliver that kind of saving. So the bottom line here is, how do you leverage people like us with our expertise and our competency and our ability to see through so many different 130 different clients as to the best practices and use that to drive the customer's own corporate end objectives and goals.
So if you were going to look at the savings, the typical savings of a client, how much of it would you say from a percentage perspective, how much of the savings would you say come from labor arbitrage, how much come from specific process improvement, how much come from the fact that you have the scale that they may not, and how much comes from just a deeper benefits that you're driving through, say, the purchase to pay area, so maybe dynamic discounting or improvements around supply chain management or improvements around analytics?
Susie, unfortunately, there is not one answer to that. So let me try and give you a sense of direction on each of those areas. So the arbitrage discussion is hugely dependent on where the original work is getting sourced from. So if you source it from an US or an UK and deliver it from a lower cost country like in India or Philippines, obviously the arbitrage is very significant in the initial years. The same is not true if you do it from continental Europe and you deliver through a front office and back office model, part of which is in Eastern Europe, balance of it which could be in a low cost country. Now as you go towards LATAM, Asia Pacific, and Eastern Europe for many large customers, obviously that arbitrage model changes pretty dramatically in terms of the proportion of the overall benefits or the overall business case. So it's a very diverse figure depending on the scale, size, and also the type of processes. As you go up the value chain, which is one of the areas where we have some pretty unique strength in, especially in finance and accounting in complex areas, the arbitrage becomes much larger than in the lower end transactional part of the value chain. The second piece is on, continuous improvement, transactional efficiency. There's two elements to that. One is what we keep on driving year on year just by, doing things better, by applying core lean and Six Sigma principles. And that number varies anywhere between 3 to 7, 8%, depending on, again, scale and fragmentation and the initial status of the processes, but that keeps on happening every year. It's rare that you won't get some benefit of that every year. Then there's a whole bunch of planned transformation projects. So the example that you took of driving e-invoicing up from, let's say, 20-25% to 60-70%, now those can deliver very significant savings. And depending on the timing of it, the savings are different. So for example, if you drive e-invoicing up right at upfront and you eliminate 30% of the processing of the overall procure-to-pay cycle resources, even before transition, then your saving from that is on the original cost base. Whereas if you do it post-transition after having taken the arbitrage benefit, then it's on a much reduced cost base, but it's still 30, 40, whatever percentage in that particular example of your core cost base. I think there's a fourth element, which is where this business impact kind of model comes in, which is where you start looking beyond just the process that is outsourced, but really start driving value across the entire enterprise process cycle, both upstream and downstream. And that value driver could be technology, that value driver could be re-engineering, but basically it is using expertise and automation and analytics. So for example, in an order-to-cash process, how you use analytics in customer segmentation and your collection strategies hugely impact your ability to collect more and your ability to reduce deductions, for example, in a consumer products company. So those numbers can then become very, very significant because they don't impact a small cost base, but they're impacting revenues, they're impacting balance sheet items, they're impacting much larger opportunity pools, if you may.
So looking at the RFPs and the tenders that you are invited to participate in, as a percentage, how many RFPs come to you where they are just looking for immediate cost savings? They're not looking for process improvement initiatives to be delivered by you?
I think all RFPs look for immediate cost savings. I don't want to underplay the need for immediate cost savings and arbitrage in our kind of a business model. It's very important because those are savings you can take to the bank. Those are savings you can put it into your financial projections plans, and they are very important. And they are needed to then take on the efforts of change management and the pains of this whole transformation journey. So all RFPs need that. I actually cannot think of many RFPs where there is no need for showing a path of improvement. And even if it is not a stated need, there is very little chance of people being differentiated other than what you can bring to the table in terms of driving improvement and driving fundamental change in your process outcomes, as opposed to just having the ability to perform that process and provide that initial set of savings. Because the reality in this market is that variation in that initial commercial structure for the relevant kind of competency organizations is not going to be very different. It's going to be a pretty small band within which it will fall.
Shantanu, you talked as well about that one of the kind of continuous improvement areas or the growth areas that you're seeing is in the analytics. How many people do you have in your analytics function today for FNA?
So, Susie, in our FNA practice today is more than 17,000 people overall, out of which about 1/3 of them work in complex areas like general ledger upwards, so they're not in the payables or the order-to-cash side. And out of that 1/3, there's a pretty large group which works on business planning and financial analysis area. So that's one set of analytics that we do. However, where we get a lot more leverage is combining the strength of our analytics service line, which is a separate 4,000 plus people service line, which are very, very adept in modeling and optimization and scenario building kind of roles. And when we work with customers to drive value in that upstream and downstream, it is not just the core FNA operating delivery people that work, but there's a lot of leverage which comes from that particular analytics organization. The second leverage happens from the organization that I run, which is really the practice organization where we have subject matter experts who are also very, very focused and very experienced on certain types of analytics. And therefore, people who are order-to-cash subject matter experts really understand how to think about collection strategy analytics. Similarly, the source-to-pay and the procurement subject matter experts understand how to do spend analytics. So it's a combination of all three: exposure and running complex processes, including basic analytics, the practice organization, and then leveraging our broader analytics service line, which allows us to create that value.